Hello, my name is Jeremy Bramwell, and welcome to our video on the construction inflation rate, the investment interest rate, and the contribution rate. First, let's go over some definitions. Contributions are the monthly or annual fees collected by the Strata Corporation as part of the annual budget for the CRF account. This excludes interest income, special levies, proceeds from a strata loan, or transfers from year-end operating budget surpluses. The contribution rate is the annual rate of change of contributions, stated as a percentage used in the depreciation report. The construction inflation rate, or the CIR, is the projected inflation rate of construction costs in the 30-year projection period. The investment interest rate is the projected rate of return in the CRF bank balance based on the cash and investment allocation mix. Inflation is a very large issue for strata corporations who must save for repairs, renovations, and replacement. The rate of construction inflation must be used and forecasted out for 30 years. The inflation rate should be based on medium to long-term averages, minimum 5 years, to remove annual variances. For example, over COVID, wood went up 400%, and then as COVID closed down, it dropped down 400%. So the variance in there was dramatic. It would have been caught in the annual inflation rate that was used in insurance appraisals, but you don't really want that in a depreciation report. Attention must be paid to the class of construction. So that's basically Class A, which is high rises, to wood frame buildings, which are typically done under a Class D type of wood frame construction, or you would have, for an industrial, you would have Class C. Each class may have different construction cost inflation rates and should be done separately. Common errors we see are not accounting for the annual variances and only focusing on the current year. This is a big problem. People who do insurance appraisals a lot sometimes use the insurance appraisal inflation for the long-term inflation, and it really can mix up the report and make it not very useful. Using a measurement tool that is too broad, such as StatsCan or the RS means, as they focus on the average increase in construction costs in a local area despite the class of construction. So, for example, RS mean will say, construction costs went up 8%, and that's 8% across everything, and you need to break it down to, is it class A, C, or D? Those are the big ones. Another problem we see is when people use the CPI, or Consumer Price Index. The CPI is rent, food, gas, things like that. It has no relationship to construction goods or construction labor. What we see when these errors occur is that underestimates future expenses, and it will create animosity and resentment among the owners when the unexpected special levies start to occur, and they will. The investment rate of return, or the IIR, is how much money you're going to get in your bank account. Now, strata corporations under the Act have limited investment vehicles they can use and tend to go to GICs for income and security. They usually want to have cash on hand for emergencies. So they'll have like $50,000 or $100,000, depending on the size of the strata. And then after that, they'll have GICs. And then the GICs will be the one that gives all the interest income. We have seen typically returns are in the 1 to 1.5 range over the last decade. What we have seen in the last couple of years, because of COVID and the very high interest rates that were in the Bank of Canada, and there is a relationship there, that it has been a little higher. But we've adjusted our reports for it. But what we are beginning to see is those GICs drop, and that will be reflected in reports going into the future. There's basically three, I'd say, groups of CRF accounts. the low value CRF. It's a situation where you've got only cash. You don't have much money in the CRF, so it's just plain cash. The IIR is very poor. It's usually under 0.5%. A medium value CRF savings plan is where you've got some cash, but you've also got some excess money. So you put it into a GIC that's basically only 6 months or a year, so it's renewed in the current year. And then we tend to see 1 to 2% as the IIR rate. You'll get the GIC might be at 2.5, but the cash is getting 0. And then we'll get what we call the high value CRS saving plans. So we get into something called laddering, and we'll get back to that in a second. So what we have here is we've got our cash, and then we've got our GICs, which were renewed in the current year, and then we've got excess money. So what happens here is the strata looks at the depreciation report, and it says, okay, so we're going to need $50,000 for items in the next 3 years, so we won't need any more money after that. So what they do is they invest in 2, 3, and 4-year GICs, depending on what their needs are going to be. And the rule of thumb is that the longer the GIC is, the greater the return. So where you might get on a 1-year GIC, you might get 2.5%, on when you ladder those second and third and 4th-year GICs, you might average out at 3.5. Now, the investment interest rate also has a lot of issues that can create errors. Calculating the IIR at the GIC rate overinflates income as it inflates the return from the cash GIC allocation mix. Now, this is fairly basic. You shouldn't be calculating your return from investments at 2.5% if 2.5% is your GIC and your cash is 0. It just makes no sense. Forecasting increases in the IIR over time is bad practice, as it's outside the scope of most reports and really can't be supported. So if you're going to say that you're going to get 2% today and you're going to get 4% in 10 years, that no one has the crystal ball. So this is why depreciation providers come back every few years to do their reports. And at that time, they calculate the investment interest rate based on the historical average that you've gotten for the last few years. One thing we see a lot of is when interest is based on the opening balance plus 50% of the annual contributions less 50% of the annual expenditures in the year. Now, this is really weird because it assumes that everybody pays on time, all special levies are paid in 12 equal installments, and that all bills are paid equally over the year. In other words, if you're doing a painting job, in the expenses for that year, you're going to pay the painter in 12 equal payments. Everybody knows that this makes absolutely no sense, but we see it all the time in some providers' reports. It will always overstate the interest income and create resentment by the owners later when the interest has not been achieved. Now, this is the largest error that we see all the time. We call this the 2 and 2, or the 2.5, 2.5, or the 3 and 3. This is when the IIR and the CIR are equal. And how this usually happens is that the provider will provide a survey to the council and say, what's the rate of return that you've been getting? And, and then the brackets will have i.e. 2%. And the strata, really having no idea, just writes down 2% because that was the number as an example. Then they'll ask them, what do you think is the inflation? And they'll use the same thing in brackets. They'll say, i.e. 2%. And then they'll just, let's put down 2%. This is really always underestimate the cost, because as you can see on the table at the bottom 2 lines, if your inflation is 2%, and your interest rate is 2%, they will wipe out each other, which really makes no sense. This will always underestimate costs and is always a big disaster, so look out for it. One question I get asked all the time is, what should be the minimum contribution rate that should be in a depreciation report? The answer is the construction inflation rate. If we look here at this table, what we see is you've got the investment income rate, in this example at 2% on a long-term basis. That means, if you think about it, 3% is the annual loss in purchasing power. So you need to make that loss up. So again, 5%, if that's the construction inflation rate, should be the minimum contribution rate used in a depreciation report. Now, the statutory contribution rate in British Columbia has recently changed. It is now 10% of the operating budget, and we see this a lot in smaller developments. They just put in the 10%, especially in bare land stratas. So if we look at our model on the left-hand side from the previous slide, and then move over to the one on the right hand, you have to understand that strata corporations, as a general rule, tend to increase their operating budgets at around 3% per year. They try that. So what we have now is a situation where you've got the 2% investment income rate, and then you've got the loss in purchasing power of 1%. This creates a very big problem, is that what you're really doing is adding another 2% for deferred for special levies. This is something that no strata corporation ever wants to do. If we take it on this graph, what we've got here in the orange is the investment income rate, or the IIR. In the blue is at 5% is the construction inflation rate, which leads us to the green bar, which is the 3% for the annual purchasing power loss. However, if you drop the annual purchasing power loss down to 1%, the red line appears, which is the deferred special levies. So, and those deferred special levies are just the levies that are going to be there for the current year. So as you can see, this is just a little 5-year projection. We put no values to it, but suddenly you're at 10% of the annual fees on an ongoing basis are deferred special levies. You're just increasing your special levies over time. It just is a killer. I hope you enjoyed this video. Strata Reserve Planning is the oldest and largest depreciation provider. We've got staff in our 3 offices in the Lower Mainland, Vancouver Island, and the Okanagan, in North Okanagan. If you have any questions, please feel free to give us a call or to send us an email to clientcare@stratareserveplanning.com. If you enjoyed this video and want to keep notified, please subscribe at our YouTube channel, which is YouTube @ Reserve Planning. Thank you very much, and have a good day.